0.3%. For the calendar year, that means that the diversified equity fund had a negative return of about 7.3%, and that is about 200 basis points below the Russell 3000. Contributors to that, the primary contributor to that below U.S. market return is, of course, the approximately 20% allocation to international equities. And as we're all aware, international equities significantly underperformed the Russell 3000, particularly from a dollar-based investor's perspective during 2018. In addition, we did have underperformance by the actively managed U.S. composite, and we'll be talking about that composite in additional detail later on. What I wanted to also note here is that for the month of December, the balanced fund fell by about 1.4%. So for the one-year return, that's a negative 2%. The International Equity Fund, as we've just noted, underperformed for the year, but for the 1 month period in December, actually outperformed the U.S. equity market by, it was about a loss of about 4.5%. Compared again, about half of the loss of the U.S. equity market during that month. The Inflation Protection Fund, which has exposure to the U.S. equity market, lost about 3.5%, and the Socially Responsive Fund followed the S&P 500's return with a loss of over 9%. So a very difficult month for December. We can talk more about the month of December, or we can turn to January. I vote for turning to January.
Before we do, though,
yes.
I do want to note and appreciate the fact that the defensive composite really did its job.
Yes.
In December.
Yes. Any other comments or questions on December? Hearing none, we have preliminary performance.
I don't think I have that page. Is it possible?
No, I have.
Oh, you have it. Great.
It was just done the other day.
Yeah, you sent it yesterday.
Yeah, yeah. So I do have hard copies.
And I'm still dizzy from the roller coaster.
Yes. Quite remarkable.
You have a market roller coaster.
Okay. Oh, would you like? Yeah, thank you, Thomas.
You're welcome.
Oh, wow.
Or the V shape as they referred to it yesterday.
Not Jay.
No.
Jay's a wow. Vineyard, right? Jay's a David vintage.
Jay Curtis, private equity.
Jersey. Oh, I didn't towards a meeting.
I read it online upstairs.
Thanks.
Who else is
I think everybody's got it.
Okay, good. So as we all heard in the sim yesterday, a very significant rebound in January, and Mike talked about some of the reasons behind that, but just to note the numbers for the month of January, the Russell 3000 was up 8.6%. So again, up 8.6% in January, down 9.3% in December. The international composite benchmark lagged the U.S. equity market in January by about 200 basis points, so up about 6.7%, with the defensive strategies benchmark earning about the same amount. And so our best guess for the benchmark return for January is positive 8%. So that same hybrid benchmark was down 8% in December, up 8% in January. You know, what I always find very interesting is looking at the impact, even on longer term numbers, of rolling out 1 month. So if we look at the 5-year average annual return for the Russell 3000 index ending January 31st, 10.4%. So you gain a month a near month and lose a month 5 years ago. If you look at the same number as of 12/31, it's 8%. That's a huge difference, 200 basis points on a 5-year average annual number.
That is amazing.
And that's the impact of volatility. And that's sort of one way to look at it. If you look at the balanced fund benchmark, that was also up about 3% in January. International equities, I've already noted, rebounded not to the extent of the U.S. equity market, but still pretty strongly. The international composite benchmark rebounded by almost 7%. And we can see the real return mutual fund was up over 4%. And the Neuberger Berman socially responsive fund was up almost 8%. So strong rebound in January. February, do you know the month to date?
Returns are sort of up a bit through the first few days, but not quite as exciting as 8%. So
certainly a return of more than, I mean, this is extreme volatility in 1 month, but I think as we launch into a discussion of the asset allocation study, we're certainly mindful of the need to discuss how volatility going forward may affect our decisions around that policy.
It also speaks to how much the endpoint that
Yes.
you look at is so it has so much effect
Yes.
on what the returns are.
Yes.
That even a month's difference in the endpoint makes this kind of
Huge difference.
Huge difference.
Which is, and the only way, the best way to deal with that is to look at rolling periods of time.
But even the rolling returns here, as you pointed out, the 5-year.
Well, the 5 years. So when we present manager returns to you, one of the things we try to present is this graph that shows rolling 5-year returns or 3-year returns at different endpoints.
Exactly.
So it isn't quite as significant an impact, but and it also, this is last time I was saying this, but it's also that problem endpoint dependency is exacerbated by the fact that humans tend to anchor onto recent experience and project that forward. You overweight recent experience. Right. And so the whole thing gets exacerbated and you really try to repeat the last 5 years. Right. And of course that's rarely successful.
Right. And one of the things you guys often say to us, I think, is that, truthfully, recent performance in terms of markets, not necessarily managers, but sometimes managers too, it generally means, like, if there's a low point, that's when you want to buy.
Yeah.
Not, international's done so poorly, let's leave international. Right. It's really the opposite that you want to go into.
Unless you can identify a fundamental reason why you think that performance will persist, right? Which is hard to do. Yeah. So unless there's any more questions about performance, maybe we can launch into our capital market assumptions. So just to remind everyone, we have capital market assumptions that we update every quarter, and more often if there's an extreme event. And these capital market assumptions form the basis of the projections of asset classes that are used when we think about how we might want to alter our strategic asset allocation policy. We collaborate with BAM, who's also using all of the other consultants' capital market assumptions. And so we discuss those assumptions and we have flexibility. So if there's a compelling argument to modify some of them, we will happily do so. But these are the assumptions that we've developed as of year end, and they'll form the basis of our discussions with you and BAM.
Great. Good morning. So I guess maybe just to start, if I had to kind of boil down our assumptions in maybe 1 or 2 sentences, it's really as simple as when markets have done well, our assumptions go down, and when markets have done poorly, our assumptions go up. So I can leave it there and call it a day, but I think you probably want a bit more detail as to how we actually build the assumptions. But to the point that was made earlier, when markets have done well, like we've experienced, notwithstanding the fourth quarter, that generally means our outlook going forward is lower. You should expect lower returns after you've just experienced very high positive returns, and the opposite is true as well. When markets perform poorly, our expectation is from that point forward, you should experience greater returns. So that's the general framework for how we create assumptions. I'll start on page 3. There's a lot of words on that slide, so I'll try to boil it down to just really some of the key takeaways there. The first that is really, really important in our assumption setting process is when we sit around and develop assumptions, we're most focused on economic factors, interest rates, equity market valuations, credit spreads for fixed income markets. We're rarely, if ever, sitting around thinking about what should the return be for U.S. equity. What we're thinking about is how should U.S. equity market valuations play out over the next 3 years, 5 years, 10 years, and that in turn influences our return expectation for U.S. equities. Similarly, for all fixed income asset classes, we generally don't sit around and think, well, what should the U.S. bond market return for the next 10 years? We sit around and ask ourselves, what do we think interest rates will do for the next 10 years? What do we think inflation and credit spreads will do for the next 10 years? And that in turn will influence our return and risk assumptions for fixed income markets. So everything you see when we get to the actual numbers for asset class return, risk, and correlation, all of that is an output rather than an input. What is an input is, again, all the different factors that I mentioned earlier, and you can see on the top left part of page 3, we list out just a decent sampling of what those factors are. We know where all those factors are today, and then we come up with an assumption for where we think those factors should be under kind of normal long-term scenarios. We call it equilibrium. So, for example, what do we think is the normal 10-year yield for a U.S. Treasury bond? And we know where we start today, and we can come up with a forecast for how we get to what we think is normal. What I would also point out is that for all of this, there's a range of outcomes. So when we look at a lot of the data and a lot of the numbers in here, it's very, very specific. 4.5% return for U.S. equities. It sort of leaves you with this impression that we have the crystal ball and there's a very precise number. And there is for the expected case, but I think, what's important here is we develop a wide range of outcomes. And as we do the capital markets modeling, as we go through asset allocation studies with clients, not only do we focus on what is the expected outcome, but we look at what are downside outcomes, what are kind of worst case scenarios. So really we focus mostly on trying to get that range of outcomes right, and try not to get too excited about what the exact expected number is for each asset class.
Can I just ask a question? What you give us is your projected returns, and you told us what your projected returns were when we did this in 2016, but you don't tell us what the actual returns have been.
We can.
What's that?
We can, absolutely.
Yeah, I think that would be useful just to understand how far off you were.
So I can. There's a couple ways to respond.
I guess we could do it by looking at the. We could look at the benchmarks.
Exactly.
Right, that you just
Exactly.
gave us.
And again, back to my opening comment of, if you look at the January benchmark report or the December numbers, which are probably more relevant for our assumptions, any asset class that's done really well, so U.S. equities, again, even in spite of the poor fourth quarter, I think we're up close to 13% for the last decade. So as a result, expectations for that asset class are very low going forward.
Okay.
So let me just add one point. So you're right, and as I looked at it again, I looked at this a lot before it was mailed out, but as I looked at it again this morning, I thought, oh, that would have been nice if we had included the actual 10 years. So and Matt and I talked about it right before we sat down. So we can give you a few of those numbers for the major asset classes, and it'll give you a sense of how different our projections are for the riskiest asset classes versus history.
And again, just to look at the January page that we just looked at, only because it's right in front of us, the most striking most striking difference in our return assumptions and what we've experienced historically is this spread between U.S. equity return assumptions and emerging market equity return assumptions. And for the 7-year period, there's not a 10-year number on this page, but for 7 years, the Russell 3000. There's a NA for the emerging markets.
Right.
But for 7 years, you have 13% annualized for the Russell 3000. You have 2% annualized for emerging market equities. So a huge gap, over 11% annualized for 7 years. To us, that spread shouldn't exist if you're investing in equity markets here domestically or internationally over the very long term, defined as 7, 10, 15 years. You should largely expect similar results, and in our mind, you should actually expect somewhat of a premium for investing in things like emerging equities and non-US developed equities.
So just to be clear, so this premium of 11% per year that you've earned in emerging markets, in US equity versus emerging markets, we are largely forecasting that to be reversed over the next decade. Now, I will tell you, we've been forecasting that for a while. So,
Broken clock is right.
yeah, at some point we're going to be right.
We keep rolling off those good months.
So, but that's an important point to be cognizant of, and the fact that we, along with, I think, virtually everyone else, has been forecasting that is why you've continued to hold on to non-US equity markets. And in fact, have during the last 7 years, you've added to emerging equities in your portfolios.
Yeah, and one of the questions, we get a similar question from clients that say exactly what Robin described. You've been recommending international, it hasn't worked out. And what we've done, and certainly happy to do this, is we've shown the realized return for the asset classes and where they fall on our range of outcomes. And what is a good, perhaps a positive takeaway for us is that everything that we have experienced was in the range of outcomes that we forecasted ahead of time. So certainly, we, as we would expect, we don't get every number right, but what we want to make sure we capture is that range of outcomes. So the 2% annualized that we've gotten from emerging equities over the last 7 years, that would have been in our range of distributions if we turned back the clock and ran our assumptions 7 years ago. If we experienced something that was way outside our range of expectations, I think that would be a little bit concerning. If you go back all the way to 2008, in fact, a lot of the work that we've done on our assumptions in the last decade plus has been centered around that 2008 event. And admittedly, 2008, that outcome wasn't in our assumptions in 2007 and 2006. So now we've been really focused on making sure that events that have happened and we think might happen are at least captured in the modeling. It's really difficult to show up at a meeting and say, yeah, that was a really tough environment that we lived through, and oh, by the way, we didn't actually capture that when we built the forecasting 3 years ago, 5 years ago. At least if we can show up and say, tough environment, but this is in what the realm of what we expected. At least kind of gives you comfort that the decisions you made were you have the right information to make those decisions.
And maybe more important, just to add one more point, maybe more importantly, looking forward, when we look at the range of distributions, we can give you a sense of what is the worst case outcome. What's the 1% outcome? And you can make a collective decision about whether that is an outcome you can live with.
And I was just wondering, do we see the range of outcomes that you're talking about?
We do have a couple slides in here that have that.
And are these the, page 4, are these the averages?
Expected case, yeah.
The 50th percentile.
Okay.
And Matt, just like that 2% that we realized in emerging markets over 7 years, what percentile of all of the outcomes was that? That was like 1 or 2, like the worst,
actually
worst
not,
10%?
if
like
you go,
to
and hopefully I'm going to turn to the page and it bears this out. If you go to page 9, you'll see here we have this is again the range of outcomes for the asset classes.
Oh, okay, sorry.
The first percent, and this is a decade, so not quite 7 years, but it'll give you a decent idea. The first percentile was about 1.5% annualized, and the 5th percentile was about 4.5% annualized. So
it was still a pretty lousy, pretty
lousy outcome, and therefore that's why the expectation going forward is much better.
Yes.
So maybe I'll just skip over. Page 5 has all the detail, different time periods, 3, 5, and 10 years. Just the one takeaway from this page is that when we show you these numbers, they're all, each period is built upon the prior forecast. So our model, let me say it differently, our model is a series of 1-year returns. So the 3-year number is really year 1, year 2, year 3. When you move out to 5 years, it's that same first three-year period plus 2 additional 1-year periods. So everything hangs together in our modeling. The 3-year number should intuitively factor into the 5-year expectation as well as into the 10-year expectation. So what I think what's probably most helpful at this point, pages 6 and 7, we can sort of look at collectively, and this is really one of the key items of our discussion this morning, is comparing our assumptions today versus what they were at the time we did the last study. And so the assumptions we used at that time were our March 31st, 2016 assumptions, so almost 3 years ago at that point, or at this point. And what we have on page 6, again, these are just some of the factors that we use, so trying to give you a sense of how valuations have changed. The couple key takeaways here. So you can see that Treasury yields from the last time we did the study 3 years ago till today have generally risen. But importantly, you'll note that short-term rates, so 1-year Treasury bills, as we know, the yield on that has moved up quite significantly in the last couple of years. So 2.6% today versus just about 60 basis points almost 3 years ago. Whereas you look at the 30-year Treasury bond, that yield today or at year end was about 3% versus 2.6% the last time we went through this exercise. And so we've made the highlight, the color highlighting there, hopefully to make it somewhat obvious that what we'll call kind of risk assets, credit markets, so corporate bonds, high yield bonds, emerging market debt, and then the equity markets collectively, even despite of the poor performance for emerging markets, valuations have generally gotten higher, and as a result, returns are generally lower. So you can see there forecasted returns, correct. So you can see, for example, U.S. equities, the valuation, we use this Shiller PE methodology there. That went from 25.5 times earnings to 28.5 times earnings. And this does include, again, this includes the very poor performance that we experienced in the fourth quarter. Some of this has reversed with January. Generally when we see extreme market moves like that, it's sometimes worth rerunning our assumptions. So as we get closer to doing the actual study, that may be something we want to take into consideration. Generally, month to month, you don't see much change, and I should point out that we update our assumptions quarterly. So from one quarter to the next, you generally don't see a whole lot of movement. In the extreme case where you have a month like January where the market's up almost 9%, sometimes that's worth just revisiting the assumptions, because a move like that could actually change the expected outcomes. On slide 7, here's again probably one of the more important slides of this morning is looking at the actual return assumptions for each asset class from the last time we did the study till today. A little bit of a mixed bag there. You can see again with the color highlighting a few asset classes which have generally higher expectations, and then a few asset classes which are generally lower. So I'd say on balance, if you were going to run a portfolio and try to understand, okay, what was a expected portfolio return from 3 years ago versus today, I'd say it's generally pretty similar, maybe even slightly, a few basis points higher. Again, fixed income is generally have higher return expectations, whereas some of the public equity markets and the alternatives asset classes are a bit more mixed.
Just a question, U.S. core, that's corporate?
Traditional investment grade, like a Barclays aggregate type exposure.
So the sort of like 1/3, 1/3, 1/3.
Yeah, corporates, mortgages, and treasuries.
Right. Okay.
Go ahead.
I was just going to ask, is there any asset class that's missing from here that, I don't know if this reflects our current portfolio, or should we talk about, if there's something new and exciting that we should take a look at?
Yeah, so these assumptions here are what we'll call the core asset class return assumptions. We do actually model, I think we're up to 44 different asset classes at this point. A lot of those additional ones that aren't on this page are sort of variations of existing asset classes. So, we model U.S. small cap equity, we model non-U.S. small cap equity. Within investment grade fixed income, we model all the different sectors like corporates and mortgages. So.
And that's likely what we'll actually use in the
more
study.
detail.
Yeah, because that's how you allocate your fixed income.
Is there anything in the TDA that we don't have in the QPP?
Convertibles.
Yeah,
Converts?
converts. And you had them in.
Right, and
Got rid
maybe,
of them.
maybe we want to put we should just keep everything open.
Yeah, and so you have, as we've talked about, you have EMD and is a permissible asset class that you're not using now.
So in the asset allocation that we adopted a few years ago, we stopped except for, I guess, placeholders, right? We got out of tips, we got out of REITs, and we got out of convertibles. And so, at least looking at this page, that seems to have paid off to some degree.
Well, yeah, I mean, that, it might not have paid, I mean, given it would be paid off going forward, but
Right.
it might not have paid off over the last 3 years, right? Because one of the reasons that you lower forward-looking assumptions is because they may have done well.
Yeah.
I mean, you can't really tell from this necessarily, right?
Yeah, and the other kind of complicating factor is what did you sell those asset classes in favor of? So if you sold convertibles and bought more U.S. equities, that worked out really well. If you sold convertibles and bought emerging market equities, that didn't work out so well. So it's in that you have to sort of think about it in a portfolio context of what did I sell and what did I buy to really understand if you made a good decision or not.
So,
I think, can I just say one thing? But I think the point the point that occurs to me with that question is one of the things we should do in the asset allocation study is look back at the progression of decisions that have been made. And, it's hard evaluating whether that was the right decision over 36 months, but I think it would be good to look at the progression of changes to the policy, and I think that will set a context. How have we moved in terms of risk and in terms of targeting new asset classes?
You'd think at a minimum and we do this with all of our clients, anytime we're doing a new asset allocation study, we always want to look at the full opportunity set and just re-underwrite. Okay, if we removed convertibles last time, what was the rationale then? Does that rationale still hold? Is there something that's changed fundamentally in that market that should put it back on the table for consideration? So we shouldn't just make the assumption that because we removed asset classes the last time that they should still be excluded. We should always kind of re-underwrite what the right opportunity set is.
a couple of notes. The two asset classes that have the biggest change are, I think, buyouts and commodities. And we don't have an allocation of commodities. And commodities strike me as very high risk. So, I'm not an advocate, at least until you guys say, oh, you really should think about commodities. But
you would take cash at the same expected
well, except
return,
that cash is obviously a very low returning
Well,
asset.
But no, well,
not so much anymore,
Really?
right? Because T-bills are up.
Yeah, it's kind of similar.
So,
Very few of our clients have dedicated
strategic
allocations
allocation to cash.
commodities
To commodities.
because they're so volatile, and they do have some, inflation sensitive
Yeah.
properties, and sometimes they can be very diversifying, but the expected return is fairly low,
Yeah,
and they're so volatile
Yeah.
themselves.
I'm curious, why, if you could explain, why buyouts have such an increase when, equity, and you just have large cap equity, and I think buyouts are more with mid cap and small cap. So maybe that's the distinction. But you've large cap equity diminished by 9 90 basis points, and buyouts gone up by 170.
Yeah, so I should have highlighted this earlier that the change in assumptions is not purely a reflection of changes in market conditions. There's also methodology enhancements that we make over time. And buyout in particular, I can recall 2 changes that we made in the last 3 years. One is that our buyout assumption now includes some exposure to non-US buyout funds. So historically it had been purely US exposure. We've now come to the view that when you're investing in buyout, typically funds allow some investments outside of the US. So that's one part of it. We also went back and revisited what our called the illiquidity premium should be for buyout, and we've raised that a touch. So the combination of including more non-US exposure in our buyout assumption, plus just our kind of what we think is a long-term normal expectation for illiquidity, we increased a bit as well. So those 2 factors have really led to what you see there in terms of the change.
I appreciate that. I do note that the equity assumptions for developed market has gone even lower. There's very little buyout in emerging markets. So it's just curious to me. I'm not saying you guys are off your rockers. But it's just curious to me.
Yeah, and again, it's more of a function of the latter, the illiquidity premium that we revisited. There's, as you might imagine, there's a lot of moving pieces behind the scenes in terms of how the numbers actually get put together. So without kind of detailing every little piece, I'll just sum it up and say there's methodology changes that are largely responsible for that difference.
And even though in non-US the forward-looking forecast has gone down, it's still significantly higher than US.
Yes, that's true. And again, and higher than the buyout assumption, even if it's gone down.
Yeah.
So again, just if you think about it, historically it was 100%. I'll just say it was 100% U.S. equity. It's again slightly different than that. So even if you removed some of it and added to non-U.S., as Robin pointed out, that still moves you in the right direction.
Right. And I think my guess is that if you look at mid cap and small cap in U.S., that's higher still, and I do think that's more correlated with buyouts than a large cap.
Yeah. So I'll maybe I'll skip most of slides 8 and 9. I think we covered it a bit. Again, the point here is that there's a range of outcomes for each of the asset classes, that all the modeling we do captures those different scenarios. And we would do the same thing for portfolio level results. So as we look at different alternative portfolios, we'll show the range of outcomes. Again, we think that is particularly helpful when going through the portfolio development process. The next kind of set of slides, there's just kind of really 2 parts left here. One is just to provide a bit more color on how we come up with our fixed income assumptions, and then how we come up with our public equity assumptions. So the first set of slides there, pages 10 and 11, are just provide some more color on where we come up with our fixed income return assumptions. And as I mentioned earlier, we're really focused on factors, and in the case of fixed income, your Treasury rate forecast is really the key component there. So what we have on slide 10 is a graphic which shows historical yields for the 10-year Treasury as well as the 30-year Treasury, and then not only our expected path, but the range of outcomes that sits around it. So maybe just to focus on the 10-year Treasury, which is the left-hand side of that page, you can see at the end of 2018, the 10-year Treasury yielded about 2.7%. The blue dotted line there is our expectation over the next 10 years. So about a 1% rise in yields. And while that may sound low, what we've also done, just for context, is put the market's expectation, which is that forward curve. So based on market pricing, you can see there's a much lower expectation of how yields will rise over the next decade. So I think this for us is a little bit of a helpful sanity check to see, not that we always want to follow what the market's expectations are, but I think it's helpful just to be cognizant of how different or how similar are our forecasts for yields versus what the market's expecting.
So your forecast is the blue dots, and you're saying the market expectation is the brown dots?
Correct, yes.
It's the forward curve.
Forward curve, yeah. And again, importantly, the rate, the bars that sit around each of those dotted lines are the range of expectations. So we got questions, or we do get questions a lot about what if you wind up in this scenario where rates stay low or go lower. You can see the range of outcomes there, the different percentiles. Certainly not the expected case, but we do build in cases where rates go lower and stay low. And that was something historically that really we hadn't incorporated. And over the last couple of years, we've now more prominently featured that in our forecasting.
Question, this is as of December 31st. In January, the Fed kind of changed its smoke signals.
Yep.
So would you think that you guys would change a bit now? And my guess is the market has changed a bit.
Yeah, and actually what we found interesting about January, we didn't spend too much time on this when we covered performance for January, but yields actually didn't react much in January, which to us is a bit surprising. So you had the fourth quarter rates fell a lot as equity markets fell. And then as equity markets performed really well in January, interest rates didn't move, hardly at all. And you would typically think in that sort of strong market environment that fixed income investments would do poorly, and that wasn't the case. So I guess that's sort of where I'm headed is our assumptions for fixed income likely would not, if we had rerun this say as of the end of January, likely would not have changed much from where we were at year end. So I think perhaps the Fed's stance was well telegraphed, and that's why rates did not move much in January. But again, if we reran these numbers as of today or as of the end of January, they likely wouldn't be much different.
Okay, that's helpful. Thanks.
And then I think page 11 just is hopefully a helpful visual looking at the yield curve where we were 3 years ago in 2016 when we did the study, as well as today. And then Rokutan, what we call our equilibrium or normal level of yield curve. Again, hopefully it's quite obvious that today's yield curve is very, very flat. There's really almost no pickup in yield going from, say Treasury bills, very short-term Treasury bills, all the way up to owning a 30-year Treasury bond. And we think the expectation is that you should get paid some premium for owning longer duration fixed income. You can see that actually, despite being as low as yields were back in 2016, the yield curve was actually what we would consider to be fairly normally shaped or slope, and you don't see that at all today. So that to us is, there is some excitement around short-term yields being higher, but the unexciting part is that you're not getting paid to take on extra duration at this point. And then just the last couple slides, I won't go through these last three individually, but these are hopefully helpful in explaining to you or giving you a sense of why our expectations for equity markets are the way they are. And the one we get asked about most, as you might imagine, is U.S. equity forecasts. So what we've done here is simply we look at starting valuations. We use this CAPE measure, cyclically adjusted PE. That goes all the way back to 1928. So we've got about 90 years worth of data there. And we break it up into 10 different deciles, 10 different starting groups. And we say from each of those starting groups, from most expensive to least expensive, what was the expectation 5 years forward? So for example, just focus on the left-hand side of the page. When valuations were in the 10% of most attractive observations, from that point forward, on average, you got about 18% a year for 5 years. The unfortunate thing is that we're at the other end of the spectrum today. So if you look at valuations today, they're in the top 10% of most expensive markets. And what that's generally led to, you can see there over 5 years, it's generally led to, call it a flat or slightly negative return for 5 years. Importantly, it's why we put the data on here. We do point out the maximum and minimum, so no guarantee, and there's a wide range of outcomes, but in general, when you've been at this point in the cycle for equity markets, U.S. equity markets, it's generally been pretty unfavorable going forward for the next 5 years.
So is this chart clear? Because I personally find this chart incredibly compelling, so it's not clear.
To me, it's not.
Okay, so
can you just
so
walk
let
us
me
through
let me restate it. So what this chart says is if you look back over the past 90 years of data, and you look at, I think it's quarterly?
Monthly.
Look monthly, and figure out what the PE ratio of the US stock market was at the end of every month over the past 90 years. And you array those PE ratios in deciles from most expensive to least expensive. So you have a huge amount of data. And you take the most expensive decile. So when PE ratios were highest, you take all those months when PE ratios were the highest, and you look out over the subsequent 5 years. On average, for that decile of PE ratios, the average return over the subsequent 5 years was negative 60 basis points. The highest return for a 5-year period in that decile of PE ratios was almost 11%. The lowest was negative 22%. So it's a very intuitive very intuitive fact, which is when you're paying a lot for stocks, which is what the PE ratio is, right? It's just how many dollars you're paying for every dollar of earnings. When you're paying a lot, over the next 5 years, you tend to return, have a lower return, right? Because your starting point is pretty expensive. Conversely, if you go to the other end of the extreme and you say, what happened in the periods of time when stocks were cheapest, the lowest decile of PE ratios, the average 5-year return for those periods of time were 18%. The best return over any one 5-year period was almost 31%. The lowest was about 7%. So the interesting thing, so one of the things when you look at charts like this, there's lots of charts like this that break historical periods of time, but it's a pretty consistent pattern. And it's so intuitive. The cheaper a stock is, the cheaper the stock market is in general, the better you tend to do. The more expensive it is, the worse you tend to do in the subsequent 5-year periods. And it's pretty consistent. There's this blip in the 7th decile. But this is an unusually consistent pattern of returns, and it's a very long period of time, and it's a very intuitively appealing concept. You pay more, you earn less. You pay less, you earn more. And so when we put in PE ratios as one of the inputs to the calculating the expected return, it leads us to have a lower expected return for the next 5, 7, 10 years. And if you look back at history, that has also tended to be the case in history.
But what about the most recent couple of years? Was this not the case?
Yes,
What?
it was.
Yeah.
It was.
And that's why we, again, we point out the maximum and minimum. It's not a guarantee. We wish it was a guarantee. We wish we could rely on this with, extreme confidence. But, again, there was a period in time where stocks were as expensive that they were the most expensive decile, and you earned 10% annualized for 5 years. That one result is not very intuitive, but it happens. And so, and I don't have the exact number, but I'm guessing the most recent 5-year period we lived through probably falls in that category of stocks were really expensive, but you did really well for 5 years. And as Robin, I think, said earlier, it's why you just don't abandon some asset classes, because they look expensive on paper.
There's another, I think that's the headline on this. There's another dynamic also when you look at these numbers. So if the valuation of the equity markets are in any of the 4 deciles to the right, the variability in returns over the following 5-year time periods is a lot wider. It's anywhere from 30 to 40%, as opposed to in the other time periods anywhere from 20 to 25%.
Yeah, we should show that as well.
So you get
Yeah, so the delta between minimum
Yes.
and
yeah. So
Yes.
it's not only the direction, but also sort of the spread.
Volatility
Yeah.
and spread. So building on the point, Susanna, is it's important, again, when we do this asset allocation study, we're going to look at the expected outcome, but we're also going to look at the range of possible outcomes, because we want to identify scenarios that may well occur, even if a small probability, and if those are completely untenable, then we need to move away from those.
Yeah, and the other, we don't need to turn there, but the next two pages show the same data for non-US developed and emerging equities, and one we have less data there, only back to 2005, but you can see, and with that smaller data set, you can see that it's just not as well behaved. I think generally you can see the pattern that Robin pointed out, kind of moving from left to right, but it's just not quite as well behaved as where we have data for 90 years in the US equity market. And again, that's just, you sort of introduce uncertainty, and all of that leads us back to wanting to own a diversified portfolio. And maybe on the margin we like US non-US equity markets, but it's just sort of a cautionary tale that nobody has the crystal ball. Unfortunately, we don't have the crystal ball, and you try to use intuition to make decisions, but we know there's some level of uncertainty always, and so you have to go back to kind of principle, basic investing principles of own a diversified portfolio, don't make extreme decisions, and so that's really, I think, important to keep in the back of your mind as we go through the asset allocation exercise.
Is there anything else in here?
No, that's all I had planned.
Okay. So much more to come in terms of assumptions, in terms of asset classes to be considered, and in terms of, I guess, a timetable for the study. Thanks, Matt. Bless you. Bless you. Chairman, should we move on?
Yes, sure, let's move on.
I think you guys no. We should hand these out.
Yes. I can hand them out and you can talk.
So right now, and you can, I'm sure based on the agenda items, what we're handing out are the 10 principles associated with the United Nations Global Compact. So there's, over the years, been a number of resolutions from the UN as it relates to human rights practices, labor practices, environmental factors, and anti-corruption guidance. And this is guidance that the UN offers not only to governmental organizations but to corporations across the globe. And so what they've done is they've synthesized all these different resolutions over the years into 10 principles that that they've provided as, in their minds, responsible approaches to conducting not only business but as a government organization, governmental entities, how you're regulating companies in your jurisdiction. So we thought that this was something that was interesting and perhaps creates some sort of framing or lens that might be helpful as we work through other projects, such as looking at the screening for emerging market portfolios. We've continued to make progress on that with the working group. And Robin and I have continued to have some conversations with the vendors and requested some additional follow-up items. We've tried to think through constructive ways of framing out the evaluation of the portfolio companies and using the data and the insights that the vendors can provide on how those companies are scoring, but also trying to marry the belief statement with how we're framing out those screens is proving to be challenging, but I think a challenge that all institutional investors that are focused in the space are wrestling with. We've had more conversations with others in the marketplace on not only the global compact, but just in general. This has really been the crux of the struggle for folks. Which factors do we care the most about, and how do we really hone in and measure those factors? And so, yes, it's easy to go out and hire a data provider, but we want to make sure that we're creating something that's more actionable based on what they can provide and how the board or any other board is approaching the space. So we found that the things that are called out in these 10 principles, which we can talk through, they're intentionally high level, and beyond, as you start peeling back the layers, the UN's Global Compact has specifics in terms of how they're looking to measure and score and how companies should be reporting, self-reporting to some degree, how they're conducting themselves to be either in accordance with these principles, and interestingly enough, we can use the data vendors to highlight where companies are not in compliance or in direct contrast with the spirit of these specific principles. So it was something we wanted to talk through a little bit and preview. I would say, and Robin, kick me under the table if you disagree. We are not experts on these principles themselves and the resolutions behind them and how they've structured the evaluation process. But in our mind, as we spent time looking at these and talking to others in the marketplace about them, they struck a chord in terms of, I think, the spirit of what TRS was looking for in the belief statement. And it seems like it might be an interesting way to communicate what you're focused on to not only your managers, but the data vendors who will be evaluating or providing some sort of assessment of company controversies and company scores. So I'll pause there.
So to add to what Mike is saying, so we didn't expect that this would provoke a detailed conversation at the board level, because we're working with the working group to on the details of this process. But what we did do, but we thought it was worth spending a few minutes introducing this concept to the board, getting any feedback you might have at this time on this subject, and then also informing you that as follow-up to the previous conversation we had regarding how to solicit follow-up from Sustainalytics and MSCI that would help us distinguish between their two processes. We've asked them to look at a emerging markets portfolio, not one of your current portfolios, but to look at an actual emerging markets portfolio and provide feedback on how that portfolio would score if you use the UN Compact at principles as a framework to evaluate those holdings. And we have shared the investment beliefs of the board with the providers, as you know, but this is a set of 10 principles that they are used to using in their processes.
What's striking me, and isn't there the UN Principles of Responsible Investing, UNPRI? And my understanding is that's sort of the standard that we ask managers whether they work within. Do you know the difference between this and that?
So my understanding is that while that references this, this is specific in looking through to underlying company business practices as opposed to investment principles that a portfolio manager would, for example, employ.
So we can come back, we have looked at that. So it's still a little murky to us, but we'll come back to you with a more specific response.
So this is specific for the business.
Yes,
how they're
it's how
supposed to
businesses
be
operating. Yes,
Yeah, and PRI is more general.
but we'll
Because I
contrast
feel like
them.
this is pretty general.
It is, it's very high level.
Except
So
on
PRI
labor,
is
I
even
think it's
higher.
very precise on labor. You know, it lists, sort of, 4 different aspects of labor, which is obviously very important to this board, which, I think is really interesting. Like what it doesn't go into, for example, the issue of supply chain, but it says businesses should uphold, the elimination of all forms of forced and compulsory labor, child labor, discrimination. There's a lot there. So on labor, not like, so maybe not on all the other things, but.
Right. So we're not recommending that the board adopt this as its framework at this
Right,
point.
but it's
We wanted to
interesting.
introduce it, and perhaps it's most useful because the data providers are used to working with this. So your investment belief statement is a custom statement, is a custom document, obviously, that they are committed to, working with. But this is something they have worked with already. And so we said to both firms, come back to us and highlight the holdings in this portfolio that are significantly inconsistent with these principles. And so we've just gotten that those reports back from the 2 providers. We'll go over it with the working group.
So, sorry,
go
just
ahead, no, go
to
ahead,
confirm, so the feedback from both MSCI and Sustainalytics, and I don't know anybody else, is
No, that's 2.
those
Those
two,
are the 2.
is that this is a framework that they've employed for other clients and they're used to working with and they think it's effective and they didn't make
Well, they don't have opinions on it, but they are very familiar with it and they have employed it.
Is there another framework that they've told you they've employed, or is this the only one?
No, I honestly, I think the big sell for them is the ability to customize and focus in on specific factors, so the specific items that I think you would even say underlie each of these 10 principles, and measuring for those. So I'll give you one specific example would be controversies surrounding workplace conditions and safety and well-being of employees. And so that specific factor, they would say the controversies they can identify related to that factor then feed into these higher level principles, and they'll specifically link how they've mapped their underlying factors like that safety issue to these principles, and it's a really helpful way of sort of outlining the different things you're focused on while letting the data provider specifically identify how they would express this preference.
Right, I mean, that makes
Yeah.
a lot of sense just in the conversations that we've had internally at BAM trying to utilize the MSCI system. So if I ask a certain question and ask for a report or a screen to be run, sometimes there's a sort of interpretation question and, trying to figure out which screens, which factors to employ. So if there's kind of, I don't want to call it like a cheat sheet, but, if I have a question about, child labor is here, and then there are factors that are in MSCI or Sustainalytics
That are linked to that.
And
This kind of
just
helps
all
connect the
seamless.
dots.
Yeah, that's
Yeah.
very
That's
interesting.
exactly, yeah. And they did not come to, the data providers didn't come to us with this. And I forget, how did we, you
So
can address it.
there was in one of the vendors' presentations,
Okay.
they did refer
Okay.
to the Global Compact, and what they said was, look, we track all these factors, you could use this as a way of linking things up, but they weren't recommending it or suggesting that that was the approach. They like to use that though, because I think there's plan sponsors or investors, asset owners, who see certain things within this that they want to be more focused
Right,
on.
exactly.
And so it's an easy way of saying, I want just this and this.
It's a summary
Yeah.
because there's so much data in these systems.
Right.
And it's very hard to sort of figure out how to make it useful for the question that you want to ask. So if you have these kind of summary level buckets, if that's what they are, or
Yeah.
buckets of
Yeah.
factors, then I think that it could go a long way in sort of helping to focus and make the data more useful.
And because the process that we're currently contemplating, and there's still discussion about that process, but because the process that at least we've been contemplating is one in which we are not precluding any investments, but we're asking managers to be mindful of principles, and then we're periodically evaluating their portfolios using certain screens. We would then have a discussion about any securities that pop up as inconsistent with these principles and screens, and we would have a discussion about it. So there's a lot of room we would expect the managers to present a compelling case about why that holding isn't inconsistent with the investment beliefs of the board, despite the score. And so there's room in the process that acknowledges that the data can be wrong, the data can be old, and there may be a nuance that the board that mitigates the issue.
Right, and with active management, that's what we want to see.
Yes,
We want
yes.
them to be taking a deeper dive
Yes.
look into each company that they choose.
There's one other wrinkle that became apparent to us as we were talking to the vendors that we think is an important consideration. So what we said when we gave the vendors this task, and they provided their feedback at the onset, we said, in addition to finding or highlighting inconsistencies with this, also let us know to the extent there's anything that for whatever reason is not included by this, but poses some sort of significant, reputational risk, exactly. And so one of the companies that actually passes the factors they've outlined for this, but something that they would put, for example, on watch or that they highlighted, which wasn't flagged from this, was, and I would argue maybe you could include it under number 10, anti-corruption, but there was, for example, at one of the portfolio companies in the sample portfolio, a bad actor who embezzled money. And so that does not necessarily mean the company did something wrong or incorrect, and perhaps they did, but I think it still prompts the same kind of conversation we would have with a manager, which is, have you evaluated the company for what might potentially be lack of controls or lack of oversight to identify something like this? And we've recognized bad actors can show up anywhere.
At good companies.
At good companies, and it might not necessarily warrant sale of the company, but it does create an additional screen or something else that we can be focused on.
So
I just want to make a comment, which is you said something, Robin, that I don't think that we've agreed to, which is that we're not talking about potentially eliminating companies, and I think that's not our understanding, at least not yet. I thought that what we were doing is looking at the potential for saying some companies we're not going to consider investable. Some companies we may engage with, and some companies we're going to, then the rest we're going to say fine. And then obviously we're going to revisit this periodically. But you said we're not considering eliminating any companies, and I don't think that's true. And in particular, I think that we are saying that with indexing, as opposed to active management, we may limit the universe. So am I incorrect with that?
no, I think there is, and you've articulated that very clearly before, and that's why I was trying to reference Rokatan's perspective. But let's divide out active versus passive, because the passive is an really important but separate discussion, and I think we can focus on the active at the outset because we're going to have primarily active portfolios. So if we focus on the active, I would agree that there well may be companies that the board decides to exclude. I think the difference in the perspective you've outlined is when you make that decision about excluding them. Do you look at the entire universe of the emerging markets index and say to managers, we don't want you to own these 10 stocks? Or do you periodically look at portfolios of active managers to see whether any of the stocks they own violate these whatever criteria we end up defining and using with the database provider, and then have a discussion about it? So I think it's a question of when and how you exclude companies, not whether there's any possibility of excluding companies.
Right, that was my understanding. The result will be the exclusion of certain securities, but the, sort of the framework is principles based.
Well, okay. I'm not saying it's not a principles-based framework, but I also thought that what we were going to do, and I think this is part of the idea of giving the companies examples to score, was that we may decide that certain companies are, under the benchmark that we set, and we do want to exclude, and we want to say from the get-go, these companies are beyond the pale. And so we want to say to the active managers, we don't want you to invest in those. I think that we are, that's where we landed. And honestly, I'm not sure whether this discussion took place here or in the working group. And I think some of this is working group discussion, not board discussion.
But I agree with what you're saying, but I think that the managers would agree if we give them a kind of clear roadmap. If we say we don't want to invest in any of this, and with our research at the beginning, you know, it's these 10 companies, they'll be like, oh yeah, those 10 companies are on our list too, based on, you know, the principles that you're giving us.
Yeah,
So you're talking about defining the permissible universe.
I am, right, and I thought that from the get-go, what we were kind of saying was, we're moving from a country screen or process to a company screen or process. And again, I thought that where we had arrived, I thought it was kind of consensus, but I may be wrong, was that, you know, we're gonna divide the emerging markets universe into 3 buckets. The no bucket, the yes bucket, and the engagement bucket. And then obviously companies can move back and forth.
I don't remember those 3
I have to
buckets.
say, I don't think that's where we ultimately arrived. I believe that what we were kind of focused on was that if we provide the managers with clear and concise direction about what we're interested in and what we're looking for, that we were pretty much trusting them to make the right decisions, because ultimately, if we've given them our principles and our statement of beliefs that outline these are the things that we're looking for, or at least these are the things that we're looking to stay away from, and then they go ahead and they find those things and they do the opposite of what we wanted them to do, that's not necessarily a smart move for them to retain and, you know, to stay our managers. So I think what I remember was we were kind of giving them the rule book and saying, do what you need to do. Don't bring us anything a year from now that we're going to be like, why did you do that? That didn't make any sense. And then if there was something that occurred in that time period, that we would sit down and say, okay, well, what do we do at this point? Do we engage? Do we walk away? Do we
So
take
Dave,
some other action?
just based on that, why are we hiring a data provider then?
We haven't
If we
decided.
have principles, what?
To
We haven't
evaluate the
just-
portfolios.
And we had, I think
Right,
what we haven't ever decided is sort of the sequence of what comes first. You know, what comes first, the data provider running the screen, or the investments, and then every year after a certain date we do an annual check. We haven't gotten there. I think we're still
Honestly, I think this is
Right.
working group
Okay,
discussion,
Okay.
truthfully.
all right. So, more to come, which I think in any event, we're gonna need a data provider, because if we change the process, we're going to need a different process to evaluate holdings, whether we develop a screened universe at the outset, or whether we just need a process defined, and I think that there's some consensus that that would include a data provider. So we will be back to the working group with the results from the data providers and more discussion about the steps in the process.
Okay.
All right. I think that concludes what we wanted to cover in the public section.
Okay, so unless anybody has anything else for the, oh, wait a second. I think the ILPA sign-on is a public item, is that right?
It can be a public.
Yeah, I think we should do that in public. So I think folks have in front of them the proposed sign-on letter with ILPA that I think we did discuss yesterday in public session. And so if folks have had a chance to review it, I think the 3 other systems that meet in caucus at the SIM all agreed to sign on to this yesterday. I think Burrs is doing a poll of his trustees. Is that correct, Mr. Rich?
It's out there right now, we'll know by tomorrow week.
Okay. And the letters do go out next week, right? Cindy?
Right, we're finalizing the signature forms. So
Right.
send out the final letter with everybody's signatures. The intent is to have each fund represented individually on the letter, so it just has more impact as 5 funds instead of the New York City funds.
So And to summarize again, the letter is urging the SEC to maintain the strongest fiduciary protections for investors in private equity funds. Do we need a motion to sign on to it? We just see if there's consensus?
I think consensus is.
Okay. So do we have consensus to sign? And obviously, I know the controller's office supports it. Is there consensus? What's that? So is there consensus to allow the teacher's retirement system to sign on to this letter?
Yes.
Chris?
Okay, great. Okay. So with that, I think that concludes our business for the public agenda. So we have some executive session business. Is there a motion to exit public session and enter executive session?
There is. I move pursuant to Public Offices Law, Section 105, to go into executive session for discussions on specific investment matters.
Is there a second?
Second?
Good. Any discussion? All in favor of the motion to exit public session, enter executive session, please say aye.
Aye.
I believe it's unanimous. So let's go into executive session. All right, we're back in public session. Susan, would you please report out of executive session?
Certainly. In executive session, there was a presentation and discussion of a sector of the U.S. Equity market and a subsector of the U.S. equity market.
Great, thank you. That concludes our business for today. Is there a motion to adjourn?
So moved.
Thank you, Mr. Kuznetsky. Is there a second?
Second?
Thank you, Ms. Vickers. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Meeting is adjourned.
Thank you.